All right, time to look at an actual policy. In this video, we are going to look at a policy for my friend KM. Now, when I say my friend, we actually have become friends over the years. I like her and her husband a lot. Actually had the privilege of meeting her in person. Most people we work with, it is almost all remote over Zoom and phone calls, but she doesn't live too far. She lives in Jersey. We're in PA, and she actually, pre-COVID, before the pandemic hit, came to an event we had down in Bethlehem, Pennsylvania, which was a lot of fun. And just a neat little story. Her and GP, who we'll talk about later, actually met each other. So we all sat at the same table and it was a ton of fun. And a lot of other people came to that event as well. But anyway, that's me just telling stories. What her plan was, well, I should start the company she selected as we looked at different options was a massive size company called Mass Mutual. Her plan was to have a policy with a total funding period of 10 years. And specifically what she wanted to do was move $75,000 per year into the policy, years 1 through 2, and then years 3 through 10, pay a total of $50,000 into the policy. Now, what's really neat or interesting about this case is plans have changed. She's not paying the same dollar amount in for the same period of time. She has adjusted payments as the years have passed, and she actually wants to stop earlier than the 10th year. So she's planning to retire early. She might continue to do things. She enjoys working. She's really smart. I say that sincerely. She's a very, very intelligent person. I'm always impressed when I speak with her. But regardless of what she does, she says, hey, if I retire and we're going to take income from this policy at some point in time, what's it look like if I stop early? So we're going to look at just that. But before we just jump into her stopping payments early, let's see the original plan. She started the policy in 2017. So why that's important is when we look at Mass Mutual as a company, when we looked at the original illustration, let's pull that up. Here's the original illustration. Started in 2017, and you'll actually see that down here, the 2017 dividend schedule. Oopsie daisy, right there. This is when she started the policy. That's when this illustration is actually when it was run. And you can tell also, if you've been in the game for a little bit, by that logo, that's not Mass Mutual's logo anymore. They have updated it. But before I just jump into everything here, I talked about Mass Mutual's dividend rate. So here's the important piece with historical performance, or what's very valuable to look at, I should say. 2017, when she started, what was the insurance company's dividend interest rate? Right here, 6.7%. What's important to note about that is when we look at a full illustration, like what we just had up and what I'm going to go back to, that illustration, if it reads current values, is based on the company's present dividend rate, and it assumes that dividend rate will be applied every single year. That doesn't happen. We can tell just from the dividend history here. This is where it's very, very important to track policy performance. We can look at in-force illustrations. What I like to look at and what we're going to reference in this video are annual statements. That allows one to see what was actually paid, real cash value, real death benefit, and then we can also cross-reference that with the illustration to see if it performed on par or if something's up. So here we go, 6.7%. Next year, what happened? Dividend came down to 6.4, did the same thing, or remained at 6.4 for 2019. So 2018, 6.4, 2019, 6.4, 2020 came down again to 6.2%, and then 2021 and 2022, 6%. She's in 2022 right now in this policy year. Her anniversary date is October. So she's nearing the end of policy year 5 and entering policy year 6. So let's take a look here and have some fun. What we will begin with, if I could speak today, is the original illustration. All right, so what do we have here from a funding standpoint? Annual net outlay, $75K per year. Years 1 and 2, and then $50K per year, years 3 through 10. Where is the money going? Policy design, premium. So this is something that once in a while we were able to get a little bit lower than 10%. We won't be able to do it today. A clean 10% would be $7,500. Here it's just about $7,300, so we're just under 10%. Mass Mutual in their software has tightened things up a bit, where if we try to run a design where it's not a 1090 split, we'll get a warning. Before it was on the illustration, now it's on the software that says it's not 10% of the base premium. Fix it because it won't be approved for sale. Not quite that harsh in their language, but the 1090 split is the most aggressive they will allow with their products. In any event, we're right there in this case. We've got 75 years 1 and 2, and then 50 a year thereafter. So years 1 through 2, how much has been paid into this policy? $150,000. By year 4, how much has been paid in? So year 3, you've got 200, because another 50 went in, and then year 4, a total of $250,000. Based on the present dividend scale, 6.7%, if that remains constant forever, what will she have? $250,000, exactly, right? Or $239 over. But you're right there. Death benefit, overinflated here. When I say overinflated, we've got a MEC limit that's higher than 75K. So that MEC limit, we want to make sure is high enough to accommodate the funding. So we'll see it on the bottom right-hand corner. MEC limit's about $80,000. Now, I want to mention something here too. What happens to unused MEC space? So, for example, to illustrate, if this is you, year 1, you pay in $75,000. The IRS limitation, the MEC limit, was $80,000. That means you could have paid in another $5,000, but you did not. So what happens here is the unused $5,000 will actually roll over to the next year. So your MEC limit then in year 2 resets at 80K plus the unused MEC space from the prior year, 5,000, 85K. Same thing will happen in the next year. The unused MEC space rolls over, is added on top of the 85. So your total unused MEC space now is $90,000, or an additional $10,000. I'm sorry. My point is unused MEC space will roll over year to year. And you've got the ability to make a large catch-up payment. In those cases, we have seen companies allow people to exceed their 10% minimum premium, no problem, because we're making up for lost time. And I think the company knows that, hey, this person can't keep doing it, otherwise they'll run into a MEC situation. But why I mention that here is this is a case where that actually happened, just as she has pivoted her strategy. So where we got the actual values you're about to see, which will be on the Excel comparison sheet, are as follows. So there's your dividend history. She started her policy in 2017. Her first annual statement here is right here. So here we've got, this is interesting on annual statements, where it reads annual base premium. That's not the base premium, as we just saw in the breakdown. So the annual statement, right, the language can be confusing, but here, the base premium will include any scheduled rider listed in the rider section. So when you've got riders attached, like LISR and AILR, those are PUA and term riders with Mass Mutual, on the statement, they're all referred to as base premium, which can be scary for some people because typically once we dig into policy design, we know base premium, bad, doesn't show up in cash value right out of the gates. In this particular case, the base premium is exactly what we saw in the illustration, about $7,300. But ending cash value, the end of the first year, almost $66,000. Now, if a policy is backdated, you will see the first year net cash value a little bit less than the illustration. So let's take a look here, actually. Well, before we take a look, this was the annual statement at the end of the first year. And then here's the annual statement at the end of 2021, which the cash value here, $381,000 and change. So as you see the actual values that have occurred each year, where we get those are from the annual statements. And this is really just call it an added service we provide for people we work with when we want to track the performance over time. And the reason why is if you have a policy, you can track the performance by referencing your annual statements, but that's a lot of work. Or you can create your own Excel spreadsheet, but that's a lot of work. So it's an added service we like to throw in there, which we recently started doing just because it takes some time, but we're getting it more systemized now. So what we've got actually, the original illustration on the left, exported to Excel, and how you can tell here, there you go, break-even point. Year 4, exactly, $250,239. Now, worst year is the first year. I pay in 75, I've got 65,683, so I take almost a $10,000 hit. What did not show up in cash value in the first year? Biggest bite out of my cash value was the base premium payment. Where the other smaller bites came from, A, from the term rider cost, which was very low in this case, and then 2, from the PUA rider fees. There are PUA rider fees. If I make a PUA payment in year 1, I'll usually see, depends on the company today, but somewhere between 90 and 95% of that PUA payment show up in cash value in the first year. Money I have access to and such, really the key to accelerating the cash value growth. Let's see what actually happened. So there's her projection based on the dividend rate of 6.7%. We don't have the declining dividends here. I could put them on Excel. You'll see them in the next couple of videos for different folks. But remember where we mentioned those catch-up payments, the non-MEC catch-up payment? Look at year 3 here as far as what she has actually done. So years 1 and 2 funded exactly according to plan. First year, you can tell here she did not backdate the policy because the annual statement matched that illustration. So when you look at a life insurance illustration, the cash values are most valid based on the year that you're in. Here we have a projected cash value. The actual value hit exactly what was projected. Where that will not be the case is if we backdate a policy, because PUA payments are always applied based on the date of deposit. Base premium dollars are applied based on the date that we backdate a policy. If we're paying monthly and making PUA payments monthly, they're applied based on the date of deposit. So there's a couple of small things there that we need to be aware of, which people look at. It's their money to say, hey, why are my values not matching up? Here it did, because she paid on time, boom, there's the value. Next year, what happened with the dividend rate? So year 1, it was 6.7%. Year 2, well, before we do that, on this illustration, the original illustration, what did the dividend project? 6.7% every year. What did it actually hit? 6.4% for the next 2 years. So she paid the same dollar amount in, but with a slightly reduced dividend. What's the difference in cash value? It's what we would expect. A couple $100. Very minimal there, a 30 basis point reduction. She's got over 6 figures in there, so about $400 there, less in cash value as a result of the dividend reduction. Now, year 3, it gets interesting because the plan was to pay in 50, and what she did is, hey, how much can I pay in? What's my total non-MEC catch-up payment? Because she had some rollover space, and she threw in almost right up to the dollar. We left a couple bucks in space there. Max funded it, made a big payment. Okay, she's at 230. This is where the original projection, can't really use it as a comparison anymore because now the actual plan has differed from the original illustration. We can still look at the break-even point where it was year 4. Year 4 now, she pays in $60,000, total of $300,000 in, and just about there. What's your dividend rate in year 4? 6.2%. So it's come down somewhat significantly now, 50 basis points, but still, you're just about there on the break-even point. What I'll add is policy design and break-even points are just actual performance. There's a big impact here, meaning actual performance is impacted based on the policy design. Specifically, what I mean is if you've got a policy that is weighted heavily toward the base premium, when dividends go down, that is impacted more. we see policies tend to underperform. When we have a policy that is weighted heavier toward PUAs, when dividends go down, we do not see as much of an impact. Meaning when dividends decline, we see base premium dollars and the actual dividend that is applied more severely impacted. What's interesting is when the opposite occurs, that's not always the case. And that's based on historical performance, actual policies we've seen. And we've got some studies on that. If you'd like to see that, leave a comment below and we will certainly provide that video. So let's continue on here. Year 5, she paid in $70K. So what's that mean? Scaled the payment up again. You can kind of see what she's doing here. She was aggressively funding it because the original plan was to fund it for 10 years, but now her plan's to retire earlier. So she aggressively funds it the first 5 years, has $370 in, $381 in cash value. This year, 2022, the projected cash value, this is October of 2022, is on pace to hit just about $407,000, and she's only paid the minimum premium now. And her plan is to perhaps pay that for another 2 years and then stop. Maybe she'll keep going, but right now this is the plan, so this is what we put together. We can adjust as the years pass, just like we did initially. But tracking the performance here, so if we stop here, looking good, and there we go. This is with the minimum premium in years 7 and 8. Nothing thereafter, cash value continues to accrue. We can throw an internal rate of return on this if we'd like. For this example, we will not. We're going to keep it simple. Let's look at one more example and see what it looks like if she decides to scale her payments up again. She can go back up to $75K if she wants. But here, let's see what it looks like if she pays in $50. And I thought about, or I look at this and think about adding a couple more years to get the same $550 in, but let's not do that. Let's assume instead of the minimum, 2 more years of 50. What happens? There's your cash value performance. Looks good overall. Strong policy. So does it actually work? In this example, yes. Granted, we're 5 years in our 6th year right now, but this is the kind of stuff we track as the years pass just to make sure policies are performing. And even if they're underperforming, I mean, there's nothing we can do to enhance the performance and make the company apply a higher dividend rate to a whole life insurance policy. We can set it up to be as strong as it possibly can from the get-go, looking at companies that have delivered, designs that have delivered the greatest value. But once it's out of the gates, like, okay, it is what it is. But my point is, if it's set up correctly, we've seen them deliver, and we've got case studies that date back much, much further than 5 years, which we can send you. Hope you enjoyed this one, though. I had a ton of fun with this and putting this together. If you have any questions, please leave a comment below. If you enjoyed this, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.